Hey, good morning, everybody. I have the famous Katara here from TappAlpha, TSPY. This is, S&P 500 with zero DTE income attached to it. How you doing, Cy? Tell us about the funds. Tell us what you're doing. Have a lot of questions here, but just tell us what you're all about.
Yeah, appreciate it. Great to be with you. It's been fun. Actually, we wouldn't be in the ETF world at all if it wasn't for Tuttle Capital. So we were actually, going down this whole path. So for folks that know my story, I was a technology guy, software guy, and kind of came into finance because of a challenge that I had in my own life. But I was like, what we discovered, we could scale it to others. But we were going to do a software as a service thing, which is just a way harder path. And then we met the Tuttle team, and so it's a huge thank you to Pete and Matt for their help, sort of taking the ideas that we had and finding a way to get it to the market with the least friction possible, and ETFs for the answer. So, it's been great to work with the Tuttle group and excited to sort of have a conversation today.
All right, sweet. So I made a list of questions. As you know, I picked out a handful of them here. I'm just going to start at the top, right? Pretty straightforward stuff. What specific market inefficiencies or investor pain points were you trying to solve when you started TappAlpha? Like, what's this all about?
Yeah, it was this new idea of people always think about portfolio construction in an either or way. So people are like, "Oh, I'm a growth investor and I have a growth slice of my portfolio," or "I'm an income investor and I have a different philosophy." But there is this massive gap that I don't think was really understood or talked about in a clear way, that actually growth plus income is almost its own category. And the reason is the two things can work together versus actually working against each other. And that was the core thing that we were looking to solve for advisors in the industry. And the why behind it was, just a little bit about my background. Like I mentioned, technology entrepreneur for a long time. I came to a crossroads in my career where, I ran a business and it was grinding for 17 years and building all this equity that I had no access to in the equity of my last company. And I was like, if I'm going to do anything else with my life, I've got to make a change. So in October of 2022, I decided to leave. But when you leave the steady paycheck, how you actually make ends meet becomes challenging. And so this is the relationship between growth and income. I used to be just a buy and hold S&P 500 guy. Was busy running the business and it did a great job for our family from the growth perspective. But now I needed income. So what do I do? And I learned about options and covered calls from my dad, who was an engineer turned advisor. But I didn't know about this brand new capability that came out, which was just short dated options. All they are options that expire every day. And so the engineer in me was like, if options expire every day, it's probably much more efficient from a risk management perspective because you have precision. So I was like, let me try it. But I didn't think that the options premiums were going to be worth much. But lo and behold, I was dead wrong. They were worth more from a unit risk perspective than actually traditional cover call strategies.
I
So,
see.
long,
I didn't know that. That's
yeah.
interesting.
So long story short, fast forward a couple months, just the options premium on top of my SPY shares covered the lion's share of our family's mortgage, and that for us was a game changer, especially at a time where I 4 months from the time that I left, we were going to have our first baby. So I was feeling the financial heat, no pun intended, of
Right.
delivering for the family. But this strategy, it took all that pressure off my shoulders. The challenge, though, was it just took time. Like if I was working full time, there's no way I could have done it. So with the software background, I ended up writing some code that took 4 hours of work every day down to under
Right.
5 minutes. And that was the aha moment where I was like, wait a minute. If I can find a way to share this value that's codified with other families like ours, we're going to make a positive impact on the world. And that's where I was deciding software or something else. And that's when I met the Tuttle team. They're like, forget the software path, just take this value, wrap it in an ETF, launch it on the NASDAQ, and you'll deliver that income directly to people's brokerage accounts on a monthly basis. And so that's what we did. And then we learned about the way those two sides of the one allocation work together, growth and income, to actually create a product that hopefully will sustain itself over the long term to continue to produce income we're aiming for it to be in a consistent way, but it's really creating a product that's built to last. And I think that's really what we're trying to deliver for the industry.
Okay, so you touch on something. I just want to start with the specifics here a little bit. Um, explain why you chose zero DTE kind of over the monthly overlays, real quickly. I mean, everyone gets it, but I just don't want to skip that.
There's actually three really important nuances to it. So when we were deciding how to build it, we actually got a big data set to give us some answers. So the first of the three reasons, if you took a 30-day option strategy at a static risk level, say 25 delta, and you got X dollars in premium, versus if you just did a 25 delta option every day and added it up the 21 trading days over that same period, you would get 4 to 4.5 times the option premium potential for the same level of risk. So I was like, that's a no-brainer. Like, why would I do the 30-day when I can get a much better premium this way? The second thing is being true zero DTE, meaning we're, 95% of the time, we're only in play with our option position for 6.5 hours a day. Guess what you're missing? Overnight risk. So you're uncapped overnight. You're uncapped on weekends. And guess when all of the planned economic events happen? Earnings happen after hours. Macro comes in before market open. So it really helps from a risk mitigation standpoint because those can have outsized movements. And if you're on the wrong side of with your option position, you get into real trouble. And then the third reason is precision. You just get 21 at bats when otherwise you get one. So the bad analogy I use is if I'm flying from Seattle to New York and I have the 30-day strategy, I get to point the nose of my airplane at JFK one time. And maybe I'm on target, but then a gust of wind comes or there's a thunderstorm on the way and it blows me off track. I don't have control to get back on track because I got my one swing. But if I use a 0-day, basically I can actually adjust my trajectory 21 or 22 times, which gives me a much higher probability to land on the runway versus a 30-day. So those three reasons made it a no-brainer that 0-day was exactly where we were going to focus. And so we built all of our tooling, all of our fintech, all of our strategy using that tool for those three reasons. And it's actually delivering really, really strong results.
Very clear explanation. That's beautiful. Okay, so I'm going to digress for a moment, right? I have a script here. I usually go a little tangential. So you've raised a lot of assets in TSPY, over 100 now, right? For 100 million, that is, yes?
TSPY is 220 right now, and TDAQ
220. Holy
over 100
smoly.
now. Yeah, it's been fast.
Okay, so that's like I thought that was just yesterday. Okay, so
It felt like
congratulations,
it, yeah. Thank you.
all that. Okay, so like congratulations, no kidding. All aside, like how does this get to a billion and or 2 and 5 and like where's the gap? Because to me, right? Like if I'm an advisor and I see this product, I have my own analysis, which is maybe not the same as yours, but I see this as like for example, I always use this analogy. I'm going to go to something I talk about. Right? Mm-hmm. So let's say you invest $10,000, right? And your stock or the SPY drops by 25% immediately. Your dividend gets cut to the level of the stock. But if the SPY rises by 8% in 10 years, you've made 5 times your money, right? And to me, that's the beauty of it, because if you can stay long, you can reinvest, you can get back. And I think, if you're an advisor, you're talking to your client, you're like, look, I'm kind of preparing you for both. Yeah, I'm going to take it, and you look smart when you talk that way to your client, I think. You tell your client, and especially even after the fact, hey, yeah, we were preparing for this. We knew this, and especially at this level. So I think it's a beautiful product. That's my digression. So how does this message get you to 5 bill, or how are people going to learn this? It seems like it's like this elephant in the room that no one sees, in my opinion. So how do you get past that?
It's so interesting because education is the most important thing. And I think, you sort of hit the subtle driver that's actually the big elephant in the room. And I'll tie it back to my story because I lived it. But in October of 22, when the markets were way down, if I had to sell SPY shares in order to make ends meet, guess what I would have missed? 2023 and 2024.
Right.
That would have been catastrophic. So being able to stay invested and generate income was the magic combination that got me through that time. So to advisors, it's the same thing. When markets go down, people's income needs don't go away. So how do you keep people invested in the market with the equity upside potential and create a product that has tax efficient distribution so that they can actually live their lives. And that was the biggest aha moment for me. I had grinded for 17 years building this business with literally zero cash out of it over a long time because I built it all into the equity of the business. And, but what I realized is like, now getting super personal, this was like, I waited till my mid 40s to get married and to have kids because everything I put into the last business. But the reality is life doesn't happen in bookends. It happens with milestones along the way. And that was the big unlock for me, not only professionally, but personally. And this strategy has helped me live my life as it comes. That was the big difference between what I was doing before, being all growth all the time, and actually realizing like, I'm going to miss the best stuff if I don't find another way to live my life and find the resources to support me in it. That was the sort of genesis and the why behind we built us building TappAlpha in the first place.
Okay, so you gave a really elegant explanation the last time of this concept. So I'm going to ask you this concept. I think people know it, but you gave a really good explanation of it before, so I'm going to ask it again. How does daily expiration change the risk profile of an ETF compared to more standard covered calls? Like, what is that all about? Like, again, you don't have to, downsell yield max and roundhill and all those guys, but like, what's the difference really? What's the simple difference?
What's the one big complaint you always hear about when people talk about covered call ETFs in general? They always tell you, well, they can't keep up with the underlying, so just buy the underlying and do that instead. But when you have zero DTE, it gives you the best chance to keep up with, and so far in our cases, knock on wood, the ability to outperform even a little bit. And you add the income piece. So really what you're giving up is that's the biggest thing that you can actually make up for. So that's number one. And then number two, when you're using covered calls, it's a hedge. So guess what happens to your beta for the advisors out there? It goes down. So our beta is about a 0.9, but we're delivering market performing or market beating growth with a lower beta. So the risk adjustment is actually much better. So the bad analogy I like to use is like the S&P 500 is your ice cream cone. We use exactly dollar for dollar that ice cream cone in the ETF. We just add sprinkles with these new capabilities with the option income engine to sort of deliver value and alpha on top.
The ice spring and sprinkles. I'm gonna have to play this one over and go through this again so I quite get that. I know it must have made sense, but I gotta hear that one. All right. So I'm gonna, I'm trying to be professional here, right? So I'm gonna ask you professional level questions, right? Um, you know, are the primary users of TappAlpha ETF individuals, advisors, institutions? How do you tailor make the message? Break that down because it seems like there's two different messages, right? I work at Tuttle. I'm in sales and
Absolutely.
marketing, whatever. It seems like it's different. Maybe it's not, but it feels like it is. Talk about that a little bit.
It's different. Yeah. So the two markets that we really are focused on, it's so far, I think our inflows have been 80% retail, 20% advisor. And part of the reason is because education and access. So retail has access and they actually review sort of online resources like YouTube and social media. Advisors, it's more of a direct one-on-one educational experience. But to your point, how do we get to a billion? How do we get to five? We take that split 80-20 and we grow it to 60-40, where maybe 40% are advisors because the scale is there. But the message and the problems you solve are very, very different. For individual investors, they're looking for how do I live my life? How do I stay invested and actually add income so that I can maybe retire earlier than I was previously anticipating? For advisors, it's different. How do I provide value above and beyond what I do on a day to day in a way that's explainable to my clients? And if advisors go out and they discover strategies like TSPY and TDAQ, and they say, oh, well, I've already got a 35 or 40% allocation to the S&P in your portfolio. I'm going to complement that or replace it with something like TSPY. And guess what? I just added a 14% income component. So now you have flexibility and you still have exposure to the underlying asset. That's a value add that advisors can explain. And over time, when they start to see the regular income come into brokerage accounts, the clients love that. And so it's how do you actually find the people and explain the value in a really effective way?
Okay, so I'm going to ask the question again. I think you just answered it, but I just want to ask the question again. So what problems are TSPY and TDAQ solving for advisors that traditional cover call and buy right ETFs don't? What is it solving specifically for the advisor? Say it like in 50 words or less.
Market-like returns with the cover call strategy and meaningful tax-efficient income that's been consistent. And those are both things in one allocation that advisors have a lot of flexibility to use in their portfolio construction.
Okay. How does the daily zero DTE approach in TSPY TDAQ change the risk return profile? You just said it, but say it again.
It lowers it. So ultimately, a cover call strategy is a hedge. It's not leverage. And so if you're able to get market-like returns with a lower beta, ours is about a 0.9, you're doing something right. And so that's one of the things that actually using a hedge like a covered call can provide, even in bull markets. Think about though, if it's a sideways or down market and you're just invested in the core equity, you're going to take the whole thing and the whole ride, as you would without any additional capability. But you add a hedge to it, it can provide you some cushion in those types of environments, so you can actually weather it in a different way than you would if you just had the pure thing.
Okay, so I think you already answered these questions, but I just want to make sure we nail this down, all right? Because
Sure.
I think this is important. So for an advisor building a 60-40 or 70-30, where do TSPY and TDAQ slot in? And then I'm going to just ask you part B, are these better used as core holdings for income-oriented clients or satellite tactical positions, whatever that means, and et cetera. So how should advisors think of position sizing? I'm going to throw all that into one big question here.
We designed it to be a core equity complement or replacement. So I'll just share what I did. I own SPY, X amount of shares of SPY. I sold all those shares and I bought shares of TSPY. And guess what? I effectively had the same number of SPY shares just within this other ETF. And then that ended up doing the options income strategy on top. So for me, I built it and designed it to be a core equity replacement or complement. Advisors, when they first hear about, and this is the education piece, they're like, oh, it's 14% income, so you must be on the income sleeve. But we talk about how it works, and they're like, oh, if I put this in my core equity, all of a sudden I even alleviate some pressure on my income sleeve to do some other things because I'm able to actually kind of scratch both itches with TSPY living over here. So those are the two main places. I'd say it's probably 80-20, 80% use it as a core equity component and 20% use it as an income replacement. So if they have like a JEPI or something like that, they see the daily benefit and then the higher and the better tax efficiency. And they're like, okay, this makes sense to do a direct replacement for some of those income.
Got it. Okay. I tend to agree with you on all that. All right. So let me get down to the next questions here. All right. These are kind of the same things we've already discussed, but let's just talk about it for a sec. How can advisors use these funds to potentially replace bonds in a higher rate, high volatility world? And do you see these tools for systematic withdrawals, et cetera, potentially reducing the need to sell underlying equities? Two different questions, but kind of the same thing. You've already touched on it, but why don't you touch on it one more time?
Yeah, I think it's another angle to look at it. Bonds are they're a debt instrument ultimately, right? And those are tied to interest rates. But as interest rates are now falling, a lot of advisors are looking for ways to replace that income. So instead, using an instrument that actually is built on volatility, not interest. And that's where options income is really interesting, because volatility is something with 0 day, you can go out and harvest, convert it to income, and replace some of the income that you're losing on a traditional 60-40.
Got it. Okay. So I'm going to do a bigger theme, step out, look back, look out from above, I guess. TappAlpha recently highlighted how daily options overlays are reshaping the income and growth conversation. Talk about how you've affected, can you talk about how TSPY and TDAQ have contributed to that shift and how you think this, what's the shift or what's going on? What's going on in ETFs, basically?
I think part of
and
it
how
is...
have you helped there?
Yeah.
How have you helped the change? What have you done?
It's really interesting because coming into the space, there was a market that already existed for high income capabilities. A lot of the conversation, though, people got wrapped around one metric, and that was yield. So the higher the yield, the better the fund. But as time went on, people didn't, they started to understand that, oh, you can't just look at one metric. You got to look at the package and basically reshaping how people understand what's in the box. So giving people tools to say, maybe yield isn't your number one metric, depending on what your goals are. Maybe
Right.
total return is something to look at. Look at total return compared to the actual distribution number. And by the way, if the security or the ETF that you're invested in, if their distribution number is higher than your total return, where do you think the difference is coming from? And so just educating people that that's coming from your principal is really something that I think we're trying to get out ahead of. And our whole goal, it's like, there's nothing right or wrong in the investing space. It's what's right or wrong for you. And so just giving people the information they need to make their own decisions.
Growth in income isn't just a slogan, it's a category you're helping to define, right? How would you articulate the edge your daily income approach, one more time, because we've already done this, versus traditional covered call products and income-focused ETFs? Just for the last call. Last call here.
Maybe another angle to sort of mention, really what it is, in a nutshell, it's a growth portfolio with a built-in income engine. And it's where you can stay invested in the market and the strategy generates income along the way. And so that's really one of the things that you've got to look at. Everything else, when I was building this, was one or the other. It was either growth or it was high income. There was nothing in the sweet spot in the middle. And that's where a lot of people, at least in my universe, lived. And that's the space that we're trying to really help provide powerful products that are sometimes, like I manage this myself in my own brokerage account. If I didn't have the time, or if I wasn't lucky enough to have the background of my parents teaching me about options since I was a kid, I wouldn't have been able to do that. But because I was lucky in that way.
Your parents were teaching you about options, huh?
Yeah. So I've been trading options 20, 25 years. I started my option trading on the wrong side. I was buying options, and that I realized very quickly was not a fit for my risk profile.
So I was trading in my own account when I was like 18 or 19 too. I was trading long calls in college,
I'll never forget Iridium. I did an Iridium trade and I made a ton of money. And then like one day later, it all disappeared. And I was like, what happened? So learning the hard way was it was good to learn it early. But flipping it, being on the sell side of options is way more in line with my kind of conservative.
You learn that as you mature and you get a little bit wiser, that's for sure.
Exactly. So that was the space that we really were trying to fill, is the space in the middle for growth plus income and finding a way to distribute things in a tax efficient way. I think that's really the place where we're going to live and build the TappAlpha product.
You know what? I don't just mean to sound up too. So explain what you mean by tax efficient way. Like, explain that real quick.
Yeah. So one thing, and I'll actually do it. I'll tie it back to my story again. When I did this strategy in my own brokerage account, I got crushed with taxes. Everything was ordinary income, not just the options income, but like the underlying growth of the S&P 500. If I sold shares maybe 18 months later, it was still taxed at short term because of the straddle rules associated with options trading and covered calls. But now take this and put it inside of an ETF, and the tax potential benefits, talk to your own accountant, are a game changer. And that was one of the biggest things that we found building it inside of an ETF and actually holding real shares. There's a real potential tax benefit in doing it that way that you don't get if you're doing it external to that.
Okay, last serious question, right? What performance or yield metrics, like if you're an advisor, what should they be looking at? What metrics, or not just advisors, all investors? What are what are the metrics people should be looking at? When they monitor TSPY and TDAQ. What are the things?
Top line, I think, is always total returns. Total returns is the ultimate performance of what the underlying ETF is doing. So it's hard, especially with income products, if you're looking at market price, because in order to get apples to apples between one fund and another, you have to add back in the distributions. Total returns does that for you already. So that is a great way to compare products over different market cycles in order to get a real feel for what the underlying ETF has earned. That's a great place to start. And then you can look at distribution percentage. And one thing that's interesting about tax efficient distributions for the advisors out there, I actually am trying to find a good way to talk about it, but it's really more of a dial. So there's a lot of investors that will buy TSPY, but they're early, like pre-retirement or just getting into retirement. They only need like 8% of the 14. And so in order to satisfy that group, the tax efficiency piece actually gives them a dial to say, okay, I'll take my 8% out, but I'll take that extra 6 and I'll just reinvest it in, and it
Oh,
doesn't
that's
hurt
beautiful.
because I don't have a leaky bucket with
I've
taxes.
never really even thought of that before. That seems
That
odd.
was,
I've
and
never
so that
thought of
was one of the
that.
things,
That's
because
a
we
great
didn't
idea.
know. Talking to Pete actually at Tuttle, he's like, retail's going to want a higher percentage, advisors are
Right.
going to want a lower percentage. What are you going to do? You're going to set 2 products up. We set 1 product up,
Right.
and you have a dial from a tax efficiency perspective that allows that, so both audiences can get what they need.
I love that. I'm going to dig into that a little bit. That's a great idea, actually. Okay, so you're a smart guy. Tell me what's in the hopper, what's coming up, what's in the lab or whatever. I mean, we have 2x TSPY TDAQ. What's up with that?
Yeah, so it's actually 30. It's 1.3, so 30%
1.3.
more
Excuse my
exposure.
bad.
Yeah,
1.3.
yeah. So
My bad.
that was one of the things we partnered with Tuttle on, was finding a way to take exactly what was in the box for T-SPY and TDAC and add 2 things to it. One, 30% more exposure, and
All right.
2, weekly distributions. And so that's all we did, is package those 2 features and capabilities in these lifted funds. So
Right.
that's been going great. People are getting familiar with, swaps and how those things work and the implementations of it. And then downstream, we really want to build a platform. So like, we have the TappAlpha income engine, which uses 0-day and technology to deliver income. But think about the ways that we can do it. We can unplug SPY and plug in almost anything else as the underlying
Right.
security, and find ways to deliver a similar value, but with a little bit of different characteristics. So if you look at T-SPY versus TDAC, they're the exact same strategy. The main difference, the NASDAQ has a little bit higher implied volatility. What does that mean? It means a little bit higher option premium, which also means a little bit higher income potential. So the
Right.
distributions between the two are almost identical to the difference between the implied volatility of the underlying
Right.
security. So we can do the same thing with other asset classes, and I think
So
that's the direction we're going to go.
So is like the good stuff? I mean, I'm just going to use the term good stuff. Is the good stuff, with more volatile names, or would you do it, let's say, with like a REIT index or
You
something?
can
You know
do
what I mean? So
both.
you get the income one way, you get it the other way.
Yeah, and you can do both, and so it's for different risk profiles or different portfolio locations, really. But the
Right.
good stuff, if you define good stuff as higher premiums and higher income,
Yeah.
the bigger the volatility, the bigger the income. So like,
Is that
the
the way you would
magnificent,
be headed more so? I guess is a real question. You'd be headed more that way, or you're headed both, or either way. I mean, if you're
we're
looking for
likely
what stuff you want to do, is it more in the volatile names or less volatile names?
we're probably going to start, because we've done the bellwethers with SPY and the Qs, but
Exactly.
probably
Yeah.
start to fill out the option portfolios that might be more cyclical. So like the Russell is one we've got a lot of inbounds for.
I see.
Mag 10 is another one we've got inbounds for. But we've also gotten inbounds for like commodities or Bitcoin. So that's like super high vol. So just finding
Right.
out like our investor set, which is really low to moderate risk investors, that's kind of where we want to sort of focus our energy moving forward with the remaining of product development that we're going to do in 2026.
All right, I'm just going to throw a flyer right at you. Last question. So
Mhm.
did you see what happened with like the silver ETF and all that over the last couple of days?
Yeah.
What do you make
Wow.
of all that? I mean, I'm going to throw you under the, this is the flyer, so
Yeah,
this is not on the script, anyone. So if he gets us wrong, he didn't know it was coming.
yeah, no, I think ultimately it was a pretty unique environment. So silver was up 125% over the last short amount of time.
Right.
And then the morning that there was the silver meltdown, it was the new Fed chair was appointed by the administration. And that took pressure off of diversification. And that's why some of the inflation in the pricing for silver and gold kind of popped the bubble a bit. Now it's kind of coming back up, but ultimately I think it's a policy decision that actually made that happen. And people are trying to predict, hey, is the dollar safe? Or if not, where am I going to put my assets? That's the debate that you're starting to see play out in the commodities market and with those metals. But the thing was, there was so much speculation that was happening that it totally inflated those numbers. And I don't think it was a terrible thing that it came down, but it was tough in the manner in which it did.
Yeah, well, all right, so I'm going to ask you one more, another flyer. So you're a smart guy. You talk about fintech. You must talk about tokenization and understand it fairly well. So, for example, again, I'm just throwing something out of the clear blue. You could tokenize whiskey barrels, right?
Mhm.
Yeah. And then you could, in theory, write a covered call on the whiskey barrels through some kind of flex option. I mean, is that ever does that ever come into your mind? I mean, like what's the pie in the sky thing that you would think about?
Tokenizing real assets is super interesting. And because it's just having a reliable way to create liquidity around different asset classes. So the thing I always think about, whiskey is delicious, I do like that, but I also think about home equity. So like a lot of Americans are sitting on a big pile of equity, but it's locked in the equity in their home. But what if you could actually tokenize your home and sell little bits of equity in it in order to basically get liquidity earlier? So there's
Great
lots
idea.
of use cases for tokenization. I think it's going to be a really powerful tool, especially if you can do it in a reliable way, which is exactly what it's built to do. So I can't wait. And like part of my original idea, right? So the company is called TappAlpha. We wanted to tap in to the income potential of the shares that I was already holding. Well,
Right.
what if you could actually do the same thing with the equity you already have in your home through tokenization? So that idea has been on the brain for a long time. There just hasn't been the tool set to do it, but it's coming, and it's coming soon.
Right. Yeah. Okay. Sai, from Tap Alpha, great guy, very smart, great products, TSPY, TDAQ, all the rest. Anything else?
No, great to be with you. Appreciate the conversation and looking
Thank
forward
you.
to everything that 2026 is going to bring us. Get ready.
All right. Thank you, sir. Have a good day. Bye.
You too.